Hello, everyone, and welcome to our webinar today, the 2023 tax changes that software customers need to know. My name is Ashley, and I'll be your host for today's webinar. Today, we'll be covering changing legislation that is impacting the software industry, getting product taxability right for SaaS services, and managing exemptions for B2B software. But before we dive into that, I do have some housekeeping items to go over. First, a friendly reminder that Avalara cannot provide legal tax advice, but we will answer your questions as best we can. On your screen is our safe harbor policy. Please take a moment to review that while I continue with some additional housekeeping items. We are recording today's event, so if you want to listen to it again or share it with a colleague, you'll receive the recording later today. The console you're looking at can be customized, so feel free to move or resize the windows. Slides can be resized by dragging the bottom corner, or you can download the PDF slide deck under additional resources. The additional resources section contains many resources that you might be interested in, so go ahead, check them out. This console will close automatically at the end of the webinar, so click them now if you want to save them for later. If you have any questions, please submit them using the Ask a Question box. We will answer as many questions as we can during the Q&A time at the end of the presentation. You can also submit any webinar troubleshooting questions in that Ask a Question box. You can join the group chat by clicking the button along the bottom of your screen that has the little chat bubbles. The group chat will pop up on your screen. We encourage you all to introduce yourself and make connections with fellow Avalarans. So you can drop in where you're calling from today. I'm calling in from the Midwest. If you have any technical issues, there is a question mark icon box along the bottom of your screen. So you can go there for guidance, or you can reach out using the Ask a Question box. We are offering 1 CPE credit for today's presentation. For those looking to receive CPE credit, please note that we'll ask you to respond to 3 of our 4 poll questions. The poll questions will pop up on your screen for a limited amount of time, so please make sure you're ready to answer when the question appears. Please don't split or tile screens on your computer, as this can affect the placement of the poll question, and we want to make sure you can see it. You must also attend the full 60-minute duration of the webinar to qualify. Once you've met those requirements, your certificate will be available to download in the Earn Certification box on your screen. You can click the icon to access your certificate, and it'll pop up in the new window for you. You'll also receive your CPE certificate in a post-event email later today. Unfortunately, we can't provide CPE credit to those who have technology issues that prevent you from qualifying. So if you do have any issues, please reach out as soon as you can using the Ask a Question box. Lastly, if you have a moment, you can respond to the survey questions on your screen or following the webinar. So with that, I would like to introduce today's presenters. First up, we have Stephen Bradshaw, partner at Bennett Thrasher. Stephen, can you take a moment to introduce yourself?
Yeah, absolutely. Yeah, hey everyone, I'm Stephen Bradshaw. I'm excited to be here. You can read my bio here, but sort of in short, I specialize in working with software businesses, a lot of SaaS companies, a lot of sort of on-prem companies, mix and match as well, and sort of do all things sales tax with software companies, including nexus studies, VDAs, preparing for sell-side diligence, and then our team's also certified implementation partners with Avalara, and so we help a lot of our clients with implementing and just helping to manage Avalara on their behalf. So yeah, very, very happy to be here.
Great. Thank you, Stephen, and thanks for being here. We are also joined by David Lingerfeld, Senior Director, Indirect Tax at Avalara. David, can you take a moment to introduce yourself?
Sure, thanks, Ashley, and hi, everybody. I'm dialing in from Durham, North Carolina today. I have a background in government administration and indirect taxes for a number of years, covering all types of activities, audit, collection, and tax controversy before I joined Avalara, and Currently, I lead the global indirect tax research teams at Avalara that power all of our products.
Great. Thank you for those introductions. Before we get started with the agenda, we do have our first CPE question. So that should be appearing on your screen right now. And the first question is, how long have you been an Avalara customer? Less than 2 years, 3 to 4 years, more than 5 years, or maybe you're not yet a customer and you're just here to learn a little more. So make your selection and hit submit, and I will advance us to the agenda slide and hand it over to David. David, I'll let you take it away.
All right. I'm seeing a black screen, so give me just a moment. There we go. All right. Thanks, Ashley. I can see the screen now. We have a number of topics to cover today. I'm not going to read all of these bullet points, but in general, we're going to cover economic nexus, how SaaS is and software is taxed and its classifications, exemptions, how mergers play in, and then some trends that are impacting the software industry with respect to tax. And then we hope to move through swiftly enough that we have time for Q&A at the end. All right. So at a glance, this industry, is huge, right? So the revenue in the global software market is expected to exceed $593 billion. Software drives so much of industry. In every industry, there's underlying software that's driving a variety of experiences, especially e-commerce. The software revenue is expected to rise 6.5% over the next 5 years. The next statistic is it costs around $1,000 per month to identify state sales tax obligations and filing requirements for small businesses. And small software businesses spend an average of 121 hours per month on tax management activities. And you can see here at the bottom of the slide a number of metrics around the cost associated with compliance, tax returns, consumers use, tax rates, exemption certificate management. When you bundle all that up, the message is tax is hard for software companies and it's expensive. But it's also really important that you understand your obligations and how to comply. And that's what we want to help educate on today. All right, there are some changing tax legislation that's in motion that is impacting the industry, and we want to just briefly touch on some of those changes. I think I jumped once more. All right, so legislation changes to note. It's difficult to keep up with this area because there are a lot of changes that are happening with each legislative cycle that we go through across the states. And they're just constant updates, not just to legislation, but updates to how legislation is being interpreted in many instances by the regulatory bodies responsible for enforcement. And so there's a lot to keep up with. And some key things to note here, Mississippi was interested in taxing. They had a study commission just recently I believe it was the end of March, there was a bill that was passed to extend taxation to digital services such as music and gaming. SaaS, that's where the software is located out of state, or hosted software where the server's out of state, will remain exempt in Mississippi, but they have extended taxation to some digital services. There was a Supreme Court case in Ohio that noted the taxability of a bundled transaction is really the true object test. This is a test that other jurisdictions apply as well, but now it's clear how Ohio applies that test with respect to bundling in the software space. Kentucky passed legislation at the end of last year that went in effect on January 1, where they imposed sales tax on a variety of digital services, including software, specifically SaaS. And then there's this recent, well, not so recent anymore, but a New York case that was at the administrative law judge level that rejected this idea that a taxpayer providing a web-based service essentially, it was allowing clients to identify and message through the information. The judge concluded that the taxpayer service was non-taxable because it was information, and the service was personal or individual in nature and not a service that is applied uniformly and accessed virtually, which is more like a SaaS versus a service. And so there's all these nuances, and this New York case really sort of lays out the framework for how judicial challenges sort of think about this area and how they tease apart whether it fits into the statute or whether it doesn't fit into the statute.
And David, if I can make a few comments,
Yeah, sure.
Just one for Kentucky. The SaaS became taxable effective January 1st, but they did offer a grace period, I think until April 1st to actually get registered. And then, just a comment on the Yesware, the New York case. It's a really interesting one. Really, the sort of takeaway is, and I'll get into this in a later slide on my end, but if you have a SaaS product, but the SaaS product is basically a component that is serving to facilitate some other service or other product, like in this case, information services, so long as that SaaS product is sort of de minimis and not, integral to the product, then that's where in this case, New York ruled that, okay, this is the SaaS component is de minimis, therefore this is just taxable as information services. And so again, I'll go into that sort of later on in one of my slides, but just wanted to comment quickly on that.
Yeah, thanks, Stephen. Right, here we go. All right, I'm going to hand off the discussion around economic nexus and sourcing rules to you, Stephen, so take it from here.
All right, great. Thanks, David. So keeping track of economic nexus rules and taxability determinations can be pretty complicated. I think at face value, once the Wayfair U.S. Supreme Court case came out, every state that imposes a sales tax adopted economic nexus. And so it seems like, oh, that's pretty straightforward. It's $100,000 of sales, or 200 transactions. But then when you actually start digging in deeper, there's a whole lot of nuances there. So for example, there's a measuring period. So every state is different on when they measure your sales to see if you cross the threshold. So some states will only look at the prior calendar year. Some states will look at the prior calendar year plus the current calendar year, and if you cross in either one. And then other states look at a 12-month sort of rolling basis. And some states like New York, they have their like inverse quarterly periods that they use that no one understands, sort of why they do that. But I think they do it on their measuring period follows their sort of inverse quarterly periods. So you take into account the measuring period, but then there's also a number of states, I think around 10 to 15 states, where they won't measure, and this is a benefit to taxpayers, they won't measure sales of other than tangible personal property. So in other words, they will only measure sales of tangible personal property. And so if you are selling SaaS into a state and you also have services, so most of my SaaS clients have, technical support or some sort of just pure services. In those states, the state will only measure the SaaS, sales of SaaS. And they won't actually measure the technical support or implementation services. They won't measure those services towards getting to that threshold. And just on to the next point about the grace periods, this is another nuance that's a way that we help our clients to mitigate particularly prior period exposure, but it can also apply prospectively as well, where we take into account grace period. So I mentioned earlier, Kentucky had a grace period of, even though SaaS was taxable January 1st of 23, they didn't require taxpayers to actually get registered until April 1st and begin collecting tax until then. So similarly, there's a lot of states that have these grace periods, and some of them are pretty sort of minor. Maybe it's to the end of that month. But there are states that have more significant ones, Pennsylvania being one of them. Pennsylvania, if you cross the nexus threshold in, let's say, May of 2022, you don't actually have to register until the following April 1st, which is pretty huge. And Pennsylvania is a state that does tax SaaS. And so those grace periods are sort of really important to take advantage of. And then the top nexus triggers that I typically see for software companies, and I sort of implied, I guess, in this is the top nexus triggers outside of economic nexus, since that's more of a straight line determination. One would be paying commissions to third parties for customer referrals. So if you have third party contractors that are out and traveling and getting sales, referring you customers, or if you have like a partner network that is referring you customers and you are paying a commission to them, this activity generally will establish nexus for you in the states where those third parties are operating, whether it's partners or independent contractors. And it's actually an attribution of physical nexus presence. So it's actually a physical nexus attribution to your company. Of course, now with remote workers, adding remote employees does establish nexus. Sometimes I get the question of, what if it's a back office person, they're not involved with any sales or anything, does that still count towards nexus? And the answer is yes, it does. It still establishes nexus. It's just kind of a slam dunk thing. Traveling into a state to visit customers, solicit new business, attend a conference. Traveling is kind of a tricky trigger for nexus. What I see typically in due diligence space, so whether I'm helping on the buy side, like with a private equity company, or if I'm helping on the sell side, helping a company kind of prepare and performing a nexus study, what typically, the threshold that I typically see in those due diligence sort of conversations during the buying process is, 2 to 3 days in the state that's enough to trigger nexus. And, if you have travel into states that exceed 2 to 3 days in any state, then the buyer side diligence team is going to say you have nexus. And that's just kind of a typical rule. If you look at the actual states, regulations or administrative guidance, a lot of states don't have guidance for how many days in a state is sufficient to trigger nexus. Some states do say they do have guidance, and a lot of times it's 1 day. So just, if you send anyone in, and then you have nexus. Washington sort of comes to mind as a state, and some states are more aggressive than others. And so traveling, but part of what I work with my clients on is, okay, there's the quantitative measure for travel, how many days in the state, but there's also a qualitative measure. So if you have let's say some back office employees that go into a state to attend a conference that has nothing to do with your customers, it's just like a continuing education kind of a conference, that I would argue on behalf of my clients would not be sufficient to establish nexus, because there's really no connection there. So that's it on travel. And then, of course, launching new products or services that can generate new customers in new states. And so, sourcing of sales of software can be kind of tricky as well. So, generally speaking, sales tax is determined by the location or the state where the goods are first used. So if you're selling tangible personal property, it's pretty straightforward. Wherever you ship the product, that state is going to control the sales tax, like the sales tax rules. For sales of software, though, it can be a little bit more challenging. It's typically still going to be where the user of the software is located. But sometimes I'll work with clients that they will sell through a reseller to an end customer. And so I think like SHI International, sort of a large, software reseller. So my client is selling to SHI, who is then reselling to an end user. So what I advise my client there is, first of all, what's on the invoice, what's in the contract. It's kind of split. Sometimes it just has the billing information or the address of the reseller. In that case, I typically tell them that's where the sales tax is sort of going to apply, is the location, the address of the reseller. But sometimes they will make use of that ship to address of actually the end user. And in those cases, that's the state that can sort of apply for sales tax purposes. So there's some complications there in the software space. It can be tricky. Documentation is key, particularly on the invoice. And the other comment I wanted to make too is that some states will provide a method of actually allocating the tax, and there's also something called a multiple points of use exemption. And so some of the states are split for how they sort of adopt these or interpret these potential exemptions. But like New York, for example, if you are a software company selling to, let's say, a large customer in New York, and let's say only 5% of the users of your software actually sit in New York, all the other users are in offices all over the country of this large customer. New York allows for an allocation of the sales tax based on the number of users that are sitting in New York. But there's a whole sort of administrative process. So anyways, that's a potential exemption, another way that we try to sort of help our clients save money, particularly with prior period exposure.
Great.
All right, I'll turn it over to Ashley.
Yes, it's time for our second CPE question. I will launch that now. It should be showing on your screen shortly. So our second CPE question is, what is most challenging for your company? Determining tax rates for goods and services, determining nexus, managing exemption certificates, managing returns, or all of the above. So take a moment and hit submit. Just as a reminder, those wanting to receive CPE credit need to answer 3 of these 4 questions throughout the presentation. So I will pass it back over to Stephen.
All right, great. And thank you all for submitting questions. I'll try to, and David will as well, I'm sure. We'll try to answer those to the best we can. So I want to move over to software taxability. This is a super sort of important thing to get right. And it's also a very complex kind of issue in the sales tax space, specifically for software companies. And this goes back to my comment on the New York case that recently, or the administrative law ruling that came out. So I want to start here with sort of the factors impacting taxability. So the method of delivery or transfer is important. The extent of the customer's interaction with the software is very important. And I'll get into that in a few minutes. Whether the product you're selling is bundled with other products is also a key component. So a lot of our clients, our software clients, will they'll have a SaaS offering or some sort of software offering, and they'll bundle in technical services, or sometimes there might be a downloaded component and a SaaS component, but it's all bundled into one charge. And so there's an analysis that sort of goes into determining the taxability. And I know David mentioned earlier the Ohio Supreme Court case that ruled the taxability of a product was based on the quote true object. That's part of that analysis is, okay, what is the customer really buying here? Are they buying the SaaS component? Are they buying the software, or are they really buying the let's say there was like a printed handout that they mailed to the customer, something that's immaterial or de minimis. In those cases, even though printed material is taxable in every state, or that imposes a sales tax, there is a de minimis sort of argument that can be made where the true object really is the software. That's what the customer's really paying for. This is just a sort of de minimis add-on here. So that's where bundling of transactions or bundling of products can be important. If two or more products are integral to the overall product that's charged a single price, then it could be that it's taxable in a state that taxes either one of those components. And language and marketing materials and legal documents and on invoices, those are the kinds of things that auditors will look to. And a lot of companies I work with, they market themselves as SaaS for multiples purposes when selling the company, but for sales tax purposes, they may be something different than that. I'm going to move at this second sort of point here is just making the point that SaaS is taxable under different categories by the states. Some states treat it as tangible personal property. Some states treat it as like a service. I'll turn it over to David here.
All right, let me come off mute. So this is just a visual to sort of reinforce some of the concepts on the prior slide that Stephen was talking about. It just kind of shows you the variation in how SaaS particularly is treated with respect to tax. The dark orange being taxable, and then you have Arizona who taxes that as a lease, and with a unique concept there. Texas also that sort of taxes 80% of the base price. And then you have this different rate here in Maryland as well. And then you have a lot of places where it's not currently taxed. And then there's one more visual, I believe. Yes. So this just breaks it down into types. So you've got canned software, which is really just, going and buying a CD, which you still can do. Particularly, you'll notice that a lot at tax season when you go in and you still see the TurboTax and other things that you could physically purchase and add to your laptop. Then you have canned software that you download, digitally download onto your device. You have custom canned software, so it's canned, but it's been customized to the extent that it makes it something different. And then you have software as a service. And what this visual is showing you is all the variation in taxation based on how the software is being delivered to you. All right, I believe it's back to you, Stephen.
All right, thanks, David. So product classification is super important. Again, it's complex. I think this is part of where our team provides actually the highest value to our clients is in helping them to get this right. So SaaS is taxable in sort of 21 plus jurisdictions, including some localities like Chicago and Denver and some other Colorado localities. But again, as I mentioned, a lot of our clients will sort of market themselves as a SaaS company, but then when you sort of dig in, they actually may be taxable for sales tax purposes as something different. And data processing is one sort of, I'll say, general tax categorization or classification that can be really beneficial to our clients, particularly for reducing prior period exposure. And for data processing, one way that at a very high level I will explain it, as it compares to SaaS, is data processing is where your company is using your own sort of proprietary software to process the customer's information and then sort of spit out an answer. So it's usually there's an API connection with the customer's own software, and there's some sort of input that the customer will send, that will ping into your software, and then you the company use your own software, your proprietary data set or software to then again kind of process and spit out an answer. So that just at a very high level, that's what data processing can be. And as opposed to SaaS, where the customer is truly the one that is interacting directly with the software through a website typically, and they are the ones sort of manipulating and doing everything. So yeah, in terms of when it comes to actually mapping software products within Avalara, it's really important to get it right. And I know I've worked, like for example, we did buy-side diligence on a customer that sort of self-implemented Avalara, and because they had some customization of their software, which is pretty common, they sort of believed that their software was custom software, which is not taxable in the majority of states. This, unfortunately, their product was SaaS, but they had a customization of canned software charge. That portion, which was a much smaller portion, was exempt in a lot of states, but not the core sort of SaaS component. And so for this particular target, I think they had like 15 million of ARR, annual revenue, and the exposure that we calculated was like $1 million. I mean, it was significant to the deal. And so anyways, that's just a sort of anecdotal story, I guess, on why it's important to get it right in the software space. And then the last kind of piece here, make sure to use custom taxability rules for products with 2 classifications. Like in the cybersecurity space, it can be important, or you might have products, you might have a product that has a downloaded component and a SaaS component that are bundled into one, and they're both integral to the product. And in those cases, you would need to charge your customers tax in any state that charges or that taxes either one of those, either component. And there's also some exemptions that I think David's going to get into a little later, where it's important to make use of those custom taxability rules, exemptions specific to software, selling software. I will turn it back over to David here.
You're on mute, David.
Thank you. I'm trying to respond to questions. I just wanted to reiterate from Stephen's point of view, the mapping exercise, if you have software that helps you do this, Avalara particularly is so critical because there are very clear distinctions in taxability based on how you map to a specific product or service. And the one that does tend to trip people up most often is this concept of, is it custom or not? And there are, and a lot of times heavily configured software to some people means that it's custom, and it's not necessarily custom. There's a distinction between configuration and customization. And so that one is really, really important.
And David, I don't think I've actually ever had a client that truly had custom software. Because it's like, you build it from scratch for basically one customer. That's custom software. So it's very rare.
Yeah, exactly. All right, so on to exemptions in this industry. So we can, what's not on the slide, I'm going to actually touch on first. And Stephen, you've mentioned it already. There's this idea of multi-points of use, right, that can be applicable in this space. In fact, is often applicable to many customers, and they're not aware of it because software is being billed to one place, but the users are all over the place or maybe concentrated in a different area. Another one that's not necessarily an exemption, but is available that some people aren't aware of is, particularly with SaaS, is R&D credits versus an exemption, and actually being able to leverage a credit for your the actual building of the software, or if the software is powering some other thing that's building something, right? You get access to these credits in many instances. But specific to this slide, there are exemptions that are sort of wrapped around what type of software it is. And we showed that in some of the visuals in the prior slides, whether it's canned versus custom. Usually true custom software is exempt. But as Stephen pointed out, it has a very specific meaning, and most software isn't really custom software. But if it is, it's typically exempt where canned software is not. The method of delivery matters in terms of how states treat it. Was it delivered physically? Was it downloaded, load and leave? That kind of stuff sort of drives whether it will be taxable or not in some jurisdictions. And the other biggie is it SaaS or is it information services, right? And Stephen talked a little bit about that already. What that really looks like in practice is the customer interacting through an HTML protocol, the web, with the software themselves, or are they passing information through some sort of call, API call, that your software is manipulating and giving them something back, a report, right? That usually is the distinction in how it plays out, but many states will tax the software, but not necessarily the service, or do some sort of unique treatment around how that's going to be taxed. Anything you would add to that, Stephen, based on customers that you've engaged with?
No, and I'm also focusing on the questions here, so sorry, I'll try to pay more attention here.
Yeah, no problem. All right, we'll move on. Let's see here. All right, so here's another visual aid to reinforce what we were talking about in the previous slide. You can see that SaaS is exempt in all of these blue states, and so you see the variation. The other states either don't have a sales tax, the nomad states, or it is taxable. And here you can see the variation again in canned versus custom versus SaaS. And you see the map as you go from, what is my left to right, you see the color gradation get more intense, right? So more states exempt as you move across the spectrum, where canned software is typically not exempt in many jurisdictions. And as you customize it or it becomes SaaS, you get more exemptions.
And David, just to clarify, I think that first one, the canned software, downloaded, sorry, it's already on there. But I did want to make one comment on the B2B exemptions for software. There's a lot of nuances there.
Yes.
Maryland, I think, is the only state with a B2B exemption where you don't actually need an exemption certificate from your customer. The other states, like Illinois, has like a 5-part test that the customer, or I guess actually that you have to attest that you meet. And North Carolina, New Jersey, Illinois, Maryland, and Iowa on the SaaS front all have some sort of B2B software exemption.
Yeah, this is an interesting segue again back to that mapping exercise, right? Because you will often find pairs of items where it's B2C and B2B, and some people don't quite understand why that's important. It is important, at least particularly important in one state in the US, but it's extremely important when we talk about international taxation. And when we talk about electronically delivered services and VAT rules for place of supply, all pivot on whether it's B2C or B2B. And so that exercise really becomes important that you make that distinction. All right. So that was a great segue into taking your software business global, and what's the impacts there. So when you think about software, it can really be accessed anywhere. So it's such an easy model to globalize. And when you actually enter other areas of the world, you're really talking about some form of VAT. And VAT really gets difficult when it comes to the reporting components of VAT and the registration requirements for VAT. And in some instances, it can be really straightforward in some European countries. In others, if you don't have local representation, it's really quite difficult just to even get registered. And so that's a component of going global with your software. I already mentioned this concept of electronically supplied services. It's somewhat equivalent to digital services in the way that we think about them in the US, but it does drive which VAT rate or GST rate actually applies in which jurisdiction, the origin jurisdiction or the destination jurisdiction. And that B2B, B2C concept really is important there, which is in this third bullet here. All right, Ashley, over to you for our third poll question.
Thanks, David. So the third poll question should be on your screen shortly. So the question is, what is the most challenging about the software industry? So those that have been in the software industry for a while, is it tracking tax legislation, determining nexus and sourcing rules, classifying product taxability, managing exemption certificates, global expansion, mergers and acquisitions? So this is kind of the format of the presentation today. So we will cover all of these if they're challenging for you, but you can make your selection and hit submit. And just as a reminder, if you're looking for CPE, you do need to respond to 3 of the 4 questions. I will pass it back over to Stephen.
All right, thank you, Ashley. Okay, so I know I've referenced mergers and acquisitions, and again, sort of performing diligence or helping companies prepare for sell-side diligence. And the reason I emphasize that is because pretty much every software company that I work with is looking to sell. They're owned by private equity, or they're, at some point in the future, that's sort of the game plan. And so that's why I think it's important to sort of focus on this. So just a few thoughts for you all as it relates to, like, if your business does kind of fall into that plan where you do want to sell at some point. I would say consider a refreshed nexus study. Physical presence, at this point anyways, is not on Avalara's economic nexus heat map. It's something that you as a company need to make sure that you're keeping up with, and using that in conjunction with the economic heat map, nexus heat map, which is very helpful. I mentioned already, 2 to 3 days of travel is a typical threshold in diligence. And so it's something to keep in mind for if you have traveling employees. Performing an updated nexus study also helps control the narrative and in diligence. And this is really helpful because the buyer side tax diligence team, their customer is the buyer, and they typically are going to be more aggressive in asserting that you have nexus, that your products are taxable in more states. That's sort of their job. And when you come in and have a report, whether the report is a nexus study with a deliverable, or whether the report is, hey, here's our tax categorization study that, it walks through why we categorized our software products as SaaS or data processing or whatever it is. If you have those reports going into diligence, it allows you to control the narrative, and you won't get bullied by the buyer side diligence team. In other words, it helps on that front. Just consider localities that tax SaaS. Sometimes those can be sort of forgotten. So I wanted to mention those. Perform a review of your product mapping. This is really important, obviously, particularly for businesses that are already using Avalara, because once you sort of get in compliance, let's say you do VDAs, you implement Avalara, having product mapping or not appropriately performing monthly reconciliation, those are the kinds of problems that come up or are more common once you actually have Avalara implemented. And just a few things that we see, as a certified implementation partner with Avalara, new products will default to being taxable in every state. And so it's important to have a process in place for if you introduce a new product in your invoicing software, to make sure that you go into Avalara and configure that software And I'm sure that there are nuances depending on which ERP or which invoicing software you're using. Sometimes I know the product mapping can actually be within the ERP, and so it's not the case for every business. And I already mentioned performing a tax categorization study. That's sort of like it helps you control the narrative going into diligence, and also for state audits as well, because we go through the facts of here's what we sell, here's the facts, and here's our analysis on why we believe it's categorized as SaaS or data processing. And then, just consider an external review of your Avalara configuration and the sales tax processes that you build around Avalara. I mentioned like monthly reconciliation. If you are issuing credit memos to customers, or if your customer gives you an exemption certificate, it'll say a month after you invoice them, do you have a process for correcting the return that was filed? So there's a whole sort of ecosystem of processes and tasks and things that are important to build around Avalara and around your invoicing software to make sure that there's no holes, basically. And so our team's obviously happy to help on that front. David?
All right. Upcoming changes that are impacting this industry. So let's sort of pivot to what's next. So there are some, there's some concepts out there that are really tangential to the conversation, but also, important to just have on your radar. E-invoicing is really big in Europe and growing, and this is the concept. If you have presence there, you have VAT obligations, you've got to file VAT returns. There are many jurisdictions that are mandating that be done through real-time e-invoicing. And so that brings a whole new host of requirements into your ecosystem about how do you do this in real time and generate the required formats, et cetera, et cetera. There's also this, developed country that's OECD, which is a group of the developed countries that are really set policy. There's a big focus on how to prevent income tax shifting, basically. And how do we prevent companies from locating in jurisdictions that have preferential tax treatment and then shifting income around so that the other countries don't get their fair share. And so there's this initiative that's generating rules that many countries are agreeing to adopt. And this is more of an income tax concept, but definitely relevant because it can affect the software industry as well. And then there's this whole idea of cryptocurrency and the metaverse and NFTs and just this emerging Web 3.0. And cryptocurrency at its core is really just a medium of exchange. It's an asset. And there's been some states that are looking at allowing regulating crypto, and New York recently blocked crypto farming and other things because of its environmental impact. But one state in particular is throwing their hat in the ring and trying to accept payments using cryptocurrencies. And so they have a set of guidelines around how you can actually file your taxes using crypto, and and how they will convert that to the US dollar, et cetera. This is just an interesting concept, not necessarily directly related to taxation, but something that is in the conversation. But cryptocurrency is built on this concept called the blockchain, right? And that's where it really matters for tax. So this is where NFTs come in. This is where the metaverse plays a big part. And NFTs is basically digital property. It's a unique digital identifier that you can't copy, you can't substitute. It certifies authenticity. It's on the blockchain. It's immutable. And then we have to think about, well, what does that even, how do you tax that? What does that look like? Is it the same as an NFT for a photo? Is that the same as a digital photo? Is it equivalent? If you tax a digital photo, do you tax a digital NFT? Most jurisdictions are, only a handful have actually issued guidance, but the ones that have are leaning towards if we tax the digital version of it, then we tax the NFT, right? But where it gets a little weird is in fashion. No one ever imagined when they were crafting legislation for digital goods that anybody would ever be buying clothing for their avatar, that how they present themselves in the metaverse, that they're shopping for sneakers and shoes. And the concept is the same. If you tax the physical form, why wouldn't the digital form be taxable, right? But the current legislation does not extend into this area. And so it's just fascinating, but there's a lot of activity, a lot of investment in this space within software. And so it's important that, if you're in this area, you pay a lot of attention to what's happening and whether it's taxable or not, because I can guarantee you, being a former state auditor, states are watching this very closely because they see dollar signs. They're like, oh, people are not paying attention. They're not taxing. We believe we should be taxing, and they will target you for an audit. It's a very common practice, right? And here is just some examples. I'm not really going to go over them, but Washington State is leading the way with their regulations in the space and really starting to try to craft a set of standards around what is an NFT and when is it taxable and when is it not. And you see other states really paying attention, because often states will mirror off of another state's concepts, right? And so this is an important set of regulations to watch that's coming out of Washington State. And then, oh, did I skip a slide? Nope, sorry, it's delayed on my side. Let's try this again. It's jumping the CPE poll for some reason, Ashley. Let me go back here. Let's try one more time, see if it will land on the poll.
I think it's a few slides later.
I'm seeing something rather weird on my side. All right, so I'm just going to jump into this and we'll see if it pops up again. But as the metaverse grows, so does the conversation, as I alluded to. You'll see lots of articles coming across on this topic. But it's fascinating to me just from a socio, and psychological standpoint. It's like, why would you want to go shopping and attend a concert with your 4D glasses on versus in person? I'm not sure why, but it's very attractive to a lot of people. But you're actually doing the same things that you might do in person. And a really great example of this is last year, one of the metaverse platforms actually hosted a concert of Ariana Grande and her avatar performed live on this platform. And millions of people around the world were watching this concert, and big name vendors sold clothing for the avatars and other accessories, just like you could buy a t-shirt if you were physically there. And so all of this stuff matters. It's like, how do you tax that? You're doing something virtually that you would also do in the real world. And, it brings into questions, well, what about sales tax holidays? If the clothing is exempt for a certain dollar threshold, what if I buy it for my avatar versus my child that's going into the 5th grade, right? So it's really valid questions, and something that if you're in the gaming space or in this NFT space, it's really important to pay attention to this. All right. How can Avalara help? So we have a host of software products that can really help keep you current in this space. As you mentioned earlier, Stephen, it doesn't completely absolve you of some responsibility to reconcile and other things, so that you don't get caught holding the bag at some later stage. But we have the capability to manage the exemption certificates that you might need. Not as super relevant for software, but there are some exemption requirements in this space. We can calculate the tax for you. A good example is as the law changes, for example, in Kentucky on January 1st, even though there's a deferment for registration, if you're mapped correctly and you're using AvaTax, you started collecting tax right away. You were doing the right thing right out of the gate because you had a software on the backside that was doing that for you. And we can also file your returns and remit your payments on your behalf. It all is a seamless system if you integrate the whole suite into your ERP or invoicing platform. There's the poll question. All right, over to you, Ashley.
Time for our final poll question, which is, what was your favorite learning takeaway from today's webinar? So there is an open text box. You can jot down your thoughts. We covered a lot of content today. Maybe you were just here for the CPE. That's fine too, but just let us know and hit submit for that fourth and final poll question. And we will move on to audience questions. So we've gotten quite a few questions, and David and Stephen, thanks for answering them throughout the presentation. Before we jump in, I just wanted to ask, were there any questions that you thought were good to call out or that you wanted to add some more color around?
I did see one. This is more of a sort of practical question. Where do you find the updated sort of taxability matrix? I think I've sent my response to everyone, but if you go to the tax code search in Avalara, and then at the top right, there's a sign in button. If you sign in, then there's a taxability matrix tab that opens up that you can then use to actually build the sort of taxability for your codes.
There's one that I want to touch on. Emily Smith submitted this question, but she's asking, is it true that amending sales tax returns will increase your chances of being audited? and I can't speak to every jurisdiction, but I can speak to one. And the answer is absolutely it will. In the jurisdiction that I was a part of for 17 years, every amended return was sent to the audit department for verification. Every single one of them. And one, they wanted to make sure the changes were supported and legitimate, but they're also looking holistically at the company that filed them and their pattern of compliance. And they're Google searching and finding all kinds of information to see if you're in the right segment that might have compliance issues, et cetera. And so, yes, it at least in this jurisdiction, it is a flag that can be used to trigger an audit.
Are you allowed to say which jurisdiction?
What's that?
Are you allowed to share which jurisdiction?
Well, I work for North Carolina Department of Revenue, so they were aggressive with their audit program, and other states are even more aggressive, and some are less aggressive. So I don't want to say this is true everywhere. Yeah. But based on the experiences I had interacting with other state administrators through CETA and some of the other bodies, other states did similar things. It is typically a tool that they use, among others, to flag potential audits.
Makes sense.
Great. Any closing thoughts before I have a couple closing slides to go over?
Not on my end.
All right, perfect. Thank you, David and Stephen, so much for your time and for putting this presentation together. We really appreciate it. I do have a couple things just to close out today. So if you qualified for CPE credit, you can download your certificate now in the CPE certificate engagement tool. Your certificate will also be available in a post-event email that you'll receive later today. Also in the post-event email, we'll include a link back to this console you're looking at now so you can watch the on-demand recording, get the slide deck, and get those additional resources. I'd like to highlight our upcoming Avalara webinars. So we have the 5 toughest areas of tax compliance and how to manage them. Next week on the 16th, we'll be covering exemptions, drop shipping, audit readiness, and more. So that'll be a good one. On May 17th, we have e-invoicing in the US, if you're interested in learning more about that. I know David touched on that briefly. And then lastly, on May 23rd, we have the 2023 State of Beverage Alcohol Compliance. So you can check out all of those webinars and more at avalara.com/webinars. I also want to talk briefly about Crush Regional, which is coming to a city near you. So Crush Regional is our event for customers where attendees can have the opportunity to learn and network with your peers. We have CPE one-on-one appointments with customer success and account managers, and we'll have 8 stops throughout the US and the UK. So be sure to check that out if you're interested at avalaracrush.com. And that concludes our webinar for today. Thank you all for joining.